The artificial intelligence world was rocked to its core following the late January 2025 news of Chinese startup DeepSeek's new low-cost, open-source AI model. A competitor to OpenAI, Anthropic, Alphabet, and Meta, DeepSeek claimed model development cost under $6 million, and that they used NVIDIA's less advanced H800 chips. Compare that to Meta's AI spending plan for 2025, upwards of $65 billion. However, a new report from SemiAnalysis, a semiconductor research and consulting firm, argues DeepSeek's hardware costs alone are more than $500 million over the company's history. That number could be even higher considering potential additional training costs.
We're not entirely sure, what the actual efficiency level of this training model is. I mean, it may not be quite as efficient as was initially thought.
Neil Calton is the managing director for utility equity research at Wells Fargo.
There's more questions than answers.
Because if DeepSeek can build large language models at a fraction of the cost, will this change the demand for advanced AI chips and the power needed to run AI data centers?
It looks like so far the outlook does not see the big tech companies in the U.S. scaling back CapEx expectations for AI.
Kit Norton is a technology reporter at Investors Business Daily. He says this also likely means the projected energy needed to build out data centers and AI infrastructure will not be negatively affected. Norton credits this to the economic principle, Jevons paradox. Increased resource efficiency leads to increased resource consumption. In other words, the falling cost of computing will rapidly accelerate AI demand rather than stifle it. Unlike what Wall Street's initial reaction suggested, the damage in AI stocks was widespread, with many top-performing companies in the artificial intelligence theme, from chips to utilities, suffering declines of 20% or more in a single day. And market participants are still trying to figure out the long-term implications of DeepSeek's new model.
It doesn't look like it may dampen the long-term outlook in terms of electricity needed for the AI boom that's still happening.
If theoretically, because this is open source, and if DeepSeek has found some sort of really compelling workaround, and the hyperscalers look into this and they can adopt some of this and say, you know what, maybe we thought we were going to spend all this CapEx and we're going to require all these GPUs for our training, maybe we can do it a little bit less. Maybe that changes the near-term picture. Again, we're not seeing that in the numbers yet.
This isn't the first time there's been a major shift in the energy market landscape. Go back about 30 years to the dot-com boom when the internet revolution spurred huge electricity demand.
Right. So, and I'm old enough to remember the dot-com bubble and the burst.
This was an era when coal was king, and many states, including California, deregulated power generation.
It was a game of chicken going on. And ultimately what happened is a lot of what was planned was built. Demand growth didn't come through. We went from being undersupplied to oversupplied, and that meant margins for the power developers became, low, very low, extremely low, actually driving many of these companies into bankruptcy protection.
With DeepSeek's disruption triggering a reassessment of AI spending, how will energy and utility companies respond this time around? Calton believes a crash is unlikely, as AI will be as revolutionary as the internet, if not more, and require even more power to fuel it.
What has happened now is that we have this AI revolution. The chips that NVIDIA and others are producing require a lot of power, a lot of compute. So the data centers that are being planned by the hyperscalers and others are no longer 100 megawatts. They're 500 megawatts, 1,000 megawatts. There's one being built in by Meta in Louisiana that's about 1,500 megawatts, we think. So these are huge.
Calton says around 3 to 4% of electricity in the U.S. is consumed by data centers. This will likely rise to mid to high single digits by the end of the decade. And when it comes to which energy sources will best suit artificial intelligence and data centers, what's old is new again.
We may have never really seen as much investor interest in the nuclear side of this ever before. Nuclear has now become kind of a golden child, really in the last year, as a way of potentially meeting the electricity demands, which are going to go up because of the data centers, while maintaining that goal of being net zero.
Natural gas could also be a key source of energy to power data centers.
You may see more deals for natural gas powered data centers, again, because that gives the flexibility to meet the demand surge or capacity, or if that capacity isn't there, you can dial it back very easily.
What's clear? AI is here to stay. The impact this powerful technology will have on the power generation market remains a burning question. For Investors Business Daily, I'm Meredith Heyman.